Good morning. Wow, what a month. We've barely survived the biggest pandemic in a century, and now onto Europe's largest invasion since World War III, not to mention 40-year highs of inflation. It's a lot to worry about. It's a lot to discuss today, but fortunately, there's nothing to panic about just yet. In fact, we are using this opportunity to nibble at select assets, and I'll tell you exactly what we are doing in the face of all these various headwinds and concerns and tragedies. Certainly, a big tragedy, what's happening in Russia and Ukraine. And it feels a bit harsh just to try and filter it down to what it means to mere numbers and money. But unfortunately, that's our jobs, and that's what we need to do. And so that's what we'll do today. So looking back at the month of February in terms of markets, some big moves in February on the Russian invasion and on US CPI hitting 40-year highs, both of which led to a lot of volatility. So if we look at the numbers in red, those are our core equities, world equities at the top. That's your big benchmark for global equities, minus 2.7%. SA equities doing quite nicely, positive 1.4%, helped largely by resources. US equities down, European equities down the most, 6.3% for the month, as a result of the concerns that they will be impacted by rising energy prices and possibly further expansion of Russia's invasion. But we don't think that's going to happen, and I'll talk more about that. Then looking at our thematic satellites, value doing very nicely for the month, only down 0.9%. Healthcare positive for the month, protecting capital. Fourth IR only down 1%. So those all doing quite nicely. Emerging markets, not surprisingly, down 3.5%. But Russia, before the invasion, only made up 3% of the emerging market basket, even less than South Africa. And so that although the impact is large with Russian equities halving, that 3% has gone down to about a 1.5% weight. It's still relatively small direct impact on emerging markets, and there's no Russian equities in any developed market indices that we hold. So it's more the contagion risks that we were worried about, not so much direct Russian holdings that has an impact. FANG did minus 8% for the month. That's off on the back of a massive performance at the end of last year. And then also some concerns about tech valuations, and we have been concerned about FANG for quite some time, particularly the big five US tech companies, which were looking a bit stretched. And then income, asset classes, SA cash, SA bonds, global bonds, US cash, gold. I classify gold as an income asset, even though the income is zero. It's one of the safe havens. So even though we had a major invasion, even though people were talking about World War III, global bonds still did not protect capital. And this just talks to the massive impact that quantitative easing has had, massive distortion that QE has had on a number of asset classes that are linked to bonds, and why we don't hold any developed market bonds. Gold, for the first half of the month, even though it was supposed to protect against rising inflation, was also down. It was only on the invasion that gold finally jumped and had a massive month, 14% in rand. So well done to all of you gold bulls. I know there are a lot of people out there who love gold. If you were holding it for inflation, then you were holding it for the wrong reasons. But if you were holding it in case of World War III, well done. You called it right and you benefited massively. I would be using this opportunity to take profits on that massive jump and diversifying into other asset classes. I certainly think other asset classes will do better over the next year than gold. But for now, gold is doing well. Yes, it is held as a safe haven asset. But South African equities worked pretty much as a safe haven asset in the month of February, up 1.4%. So you do get sufficient exposure to resources just by holding the index, South African equity index. You don't actually need any further exposure to other asset classes that are distorted by quantitative easing. But that's just my view. You know that I'm quantitative easing there, and all the asset classes that have been distorted by that, I'm very concerned about. But gold did do well this month, and I must say well done to all those gold bulls. May you enjoy it. So let's go further into the politics, the geopolitics, the moves that's happened in the various economies, and try and work out what is going to happen going forward, what we should be doing to position our portfolios, how we should react. Certainly, there's been a big move in a number of commodity prices, gold, oil, natural gas. A lot of people are buying those asset classes or any exports, big Russian exports, to hedge their portfolios. You know, that's a sensible move if you can time it right. It's a sensible move on a short-term call if you know exactly when the war is going to start and when the war is going to end. But for most of us, I think it's safer just to look through this and not panic, and buy those assets that are cheaper on a long-term basis, not that are suddenly expensive on a short-term basis. So it's all about Putin. He's having his day in the sun, or his day in the atomic cloud, as he would prefer it. And as you are all well aware, Russia made a full-scale invasion of Ukraine this month, with ongoing bombardments of cities, particularly Kharkiv as we speak. There are low-level peace talks ongoing on the Belarusian border, but that's unlikely to lead to any successful outcome. Russian equities are down 70% from their peak. As I said, they now make up less than 2%, closer to 1% of the emerging markets basket. They're down to 2 PE. That's staggeringly low numbers. The ruble is down 30%, and things are looking pretty dire in Russia. Most importantly, the US and EU have blocked Russia's central bank from accessing its dollar currency reserves. So now Russia has about $640 billion of foreign currency reserves. Those are its assets, its money, its savings, to try and fund government spending, to try and keep the currency stable. It's their money. And because 400 billion of that 640 billion is currently in dollar assets in Western markets, the EU and US have been able to block that $400 billion worth of assets. So it's quite a massive move, and certainly has some impact on the Russian invasion, and certainly must be having some impact on Putin's view. However, there's still 240 billion that they can spend, which will certainly get them through the current invasion. And we don't think it's going to stop the invasion going forward. So what do we think is going to happen? Well, okay, if you look at the chart on the right, as I've mentioned before, energy prices have soared as Russia invaded the Ukraine, and oil topping $100 a barrel, and natural gas prices surging, having a massive impact on energy prices in Europe and the UK, where they've been doubling of some retail heating prices for homes. Certainly is a concern for inflation. But Russia doesn't want to lose access to the West's energy needs. And certainly in the previous invasions, where there were sanctions put in place, Russia continued to export oil during those crises or invasions. And the West also doesn't want to use sanctions that will impact its growth. So Europe and the UK are dependent on Russia's gas and oil imports. Russia makes up about nearly half of Europeans' natural gas imports, so it's not a small amount. So you have this standoff where yes, sanctions certainly have elevated as Russia's invasion has elevated or escalated, but a full-scale impact of sanctions will probably hurt the EU too much. So it's going to be a balancing act. So the likely outcome is Russia will stop at the Ukraine. So there's very little chance it's going to invade any of the NATO countries. It doesn't have the firepower, it doesn't have the stamina, it can't afford it. But it's also unlikely that they're going to stop the invasion before they've taken the capital city of Kiev. And that is becoming quite a dirty, ongoing struggle. It's broadened out to be using weapons that are banned by the Geneva Convention. There are a lot of civilian casualties. As soon as a bit of guerrilla warfare, it's not looking pretty at all. And that's why there's been an escalation of sanctions. But so far, those sanctions have been limited. There's not full-scale sanctions. Russia retains swift access for some of its banks, and Russia is still exporting oil and natural gas. So we haven't hit the full-scale sanctions, which would not only cripple Russia, but cripple Europe. And we're unlikely to do that. It's more likely that the war is going to continue for some time as this guerrilla warfare extends. There isn't going to be, it's very unlikely that there will be a peaceful outcome between Ukraine and Russia. Putin wants to take the capital city and wants to install his own government there. So that may extend for some time, and volatility may extend for some time. But it's unlikely to extend past Ukraine. And if that is what the outcome is, besides extended volatility, the biggest impact to the rest of the world is higher energy prices. Fortunately, that looks like it should be capped as well. Iran's nuclear deal talks are ongoing. OPEC Plus is increasing oil supply, with Iran there coming to the party and increasing supply quite significantly. So barring any further escalations of sanctions due to further escalations in Ukraine, oil should remain around $100 and drop off quite soon thereafter, back down to the mid-80s. So while it is prudent to own some commodities that Russia does export, palladium being one of the biggest ones in terms of global market share, and that certainly is helping South Africa right now, we think that there's limited scope for this war to extend much worse than this. We think we're closer to the peak. Yes, Kiev still needs to fall, and yes, that could get quite ugly before it falls, but that is probably closer to the end than the beginning. So while it may be too soon well, certainly it's definitely too soon to be buying any Russian assets, and in terms of investing in emerging market indices, while as soon as sanctions are placed on certain Russian banks, those stocks are removed from the various indices by the index providers. So there may be some forced selling of some Russian assets, but it's a very small impact on the overall portfolio. The biggest impact is inflation, as I said. So this was one of the risks that we were concerned about at the beginning of the year. We didn't think that there would be a full-scale invasion. Certainly it did catch the market by surprise. Everyone thought it would be limited just to the eastern regions of Ukraine. It has turned out to be a full-scale invasion, but it's unlikely to go past Ukraine. And the broader impacts on global equities are likely to be felt through inflation, and that will impact global growth, unfortunately. So it used to be all about the Fed and Powell and US inflation. And at the start of February, there was massive volatility and distortions amongst various asset classes as US inflation hit 7.5%. The world and markets were expecting inflation to actually have rolled over and to start decrease, and it continued to escalate in the US, and that made people start to reevaluate their models. Is inflation here for longer? Is the Japanification and secular stagnation models of disinflation gone, and it's now time to move into a stagflation environment? Should we be realigning our portfolios and buying commodities and selling equities, buying inflation-linked bonds? How should we be changing our portfolios? We still believe that this is not the case, that inflation, while we expected it to be transitory for longer, we still believe it is transitory and not going to impact the long-term inflation expectations. And for the moment, the market medium-term expectations are muted. So I think at the moment, the market agrees with us. Yes, there are risks with an increase of energy prices, but at the same time, the uncertainty that's been caused by the wars means that the Fed is probably going to be a little bit more dovish and cautious in terms of raising rates, and that's all that matters. We don't want the Fed to panic and to cause a recession by raising rates too soon. So why are we still not concerned about inflation structurally being higher for longer? Why do we think that it will come down in the medium term? Well, firstly, it's COVID supply disruptions. Those are already rolling over. We've spoken about that before. But the other impact is wage inflation. Now, wage inflation in the US is looking quite scary. But if you look into the details of wage inflation, the majority of that inflation is at the bottom end of the income curve. And that's the area where we're still not at full employment. So there's a lot of scope for employment still to rise at that area without impacting inflation. And so as the COVID benefits end, we think that participation rates in that lower income will rise and wages will actually reduce or steady at that lower income range. The other big impact that we had, particularly in the US, and a lot of people are wondering why there's this massive disparity with inflation. US at nearly 8%, Europe close to 5%, and Japan and China around 1%. And that certainly speaks to a very disparate impact of inflation. And a lot of that has to do with the wealth effect. Unprecedented levels of monetary and fiscal support in the US led to the biggest increase in wealth effect in history. The US's wealth effect jumped to a 50-year high, and all that money had to be spent somewhere. Everyone was feeling really wealthy, which is contrary to what normally happens in a recession. In a recession, people normally feel poor. But for the first time, this recession was so aggressively acted upon by the Fed and the US government that people felt rich. It was a recession, they felt rich. They couldn't spend it on holidays and restaurants. They spent on goods, and it led to massive goods inflation. But as you know, if you buy TV this year, you're not going to buy a TV next year. So we are expecting goods inflation to come down. Services inflation, that hasn't really caught up, so it's still lagging. But just because you missed your overseas holiday last year doesn't mean that you're going to have 2 overseas holidays next year. You might. Some people who are lucky will, but the majority of people will just have 1 holiday. So the wealth effect is going to normalize. As interest rates start to rise slightly, property prices will stabilize or roll over, equity prices in the US will stabilize and roll over, and that will have a calming impact. And there's a good reason for that. I mean, I'm not as bearish as GMO, but GMO put out a fascinating report, and I recommend that anyone who is worried about US valuations Google the GMO report about the simultaneous bubble that's happening currently in the US property markets and the US equity markets. So the last time the US had what they called a 3 sigma event in terms of valuations was only on one asset class. That was US equities, and that was the late 1920s. And that preceded the Great Recession, the Great Depression, as you all well know. The only time in history there's been a double 3 sigma event in 2 asset classes, which was Japan in 1989. And Japan still hasn't recovered. Its property prices and its equity prices aren't back to its 1989 highs, 30 years later. So if GMO is even slightly right, US prices need to come back. And as interest rates rise, those prices, US property prices and equity prices will come off slightly, and that will lead to the wealth effect reducing, which will then lead to a decrease in inflation in the US. So that's one of our biggest reasons for not being concerned about inflation. Now, the big risk is on how that bubble is deflated. It is clear that it is a bubble. If the Fed raises rates too quickly, then we will have a Japan 1989 story. There will be up to a 50% fall in US equities and a 40% fall in US properties. But the Fed is well aware of this, and we think the Fed is going to trade very carefully. And that's why we think they're not going to raise rates too quickly. They just can't afford to. They can't afford to crush property and asset prices by raising the cost of debt too much. But that is a big risk. So one of the biggest risks to the next 5 years is the Fed raising rates too much and the bubble bursting in the US. But we don't think that's going to happen. One of the reasons is that US value stocks are still relatively cheap. European and Japanese stocks are cheap relative to history. Emerging markets are incredibly cheap relative to history. So the most likely outcome of what we're seeing, we saw it in January and we saw it again in February, is that US will slowly deflate as US large cap tech valuations normalize. And there will be a switch out of the US into, or in the US from growth to value, and out of the US into other asset classes. Also, the biggest impact, the biggest way that the S&P is likely to devalue is not by it falling so much, but by the dollar devaluing. And it's one of the reasons why we are comfortable to underweight the US. Not only are we worried about large cap US tech valuations, but we're also worried about the dollar. And we do think that this is going to happen over the next decade. Over the next decade, the dollar is likely to weaken. US valuations are likely to decrease, and there'll be a shift out of growth into value and a shift out of US growth into other asset classes. And this is being driven by rising US interest rates. So the 30-year real yield turned positive for the first time since June last year, and that caused value to continue to rise. But the chart here on the right shows the relative valuations of value divided by growth. So if we're below the dotted line, you one standard deviation cheap. If you're above the dotted line, you one standard deviation expensive. Right now, as you can see, value in the US is in the world is between 2 and 3 standard deviations cheap. So value is a good place to hide in the short term. Growth is not looking as expensive in Europe and Japan and emerging markets. It's predominantly US growth with a bubble sitting. And that is purely evident in the volatility that we've seen in the markets. So in the month of February, we had massive volatility. Meta Platforms, the old Facebook, they put out a disappointing trading update. There were a reduction in advertising revenues and a decrease in number of users. That led to the single biggest market loss in history. Meta fell 26%, wiped out $251 billion. It's just a staggering amount, the biggest loss in history. You have to wonder how analysts, there are more than 100 analysts around the world focusing on understanding one of the biggest companies in the world, how they got it so wrong. And you have to wonder how good active management is when you've got 100 incredibly well-paid sell-side analysts who get it so wrong. Anyway, to try to put that loss into perspective, $250 billion. That's Elon Musk's entire wealth. It's also the entire cost of World War I. And even further, when Russia invaded Ukraine, on that day, the Russian stock market fell 60%. It wiped out $250 billion. So World War III, basically in Europe, Russia invading Ukraine, it's losing more than half of its market cap, was just the same impact as Facebook putting out a disappointing trading update. It's just incredible, and it speaks to the fact that the US is that particularly these stocks are overvalued, and the volatility speaks to that overvaluation. The next day, a day later, Amazon gained 14%, gaining 191 billion because it put out a trading statement that was better than expected. Again, how do analysts covering these top 5 companies, the $5 trillion club, the biggest companies in the world, how does they get it so wrong? So that speaks to why we remain comfortable being underweight the US. It's still a big portion of our funds, don't get me wrong. I keep saying that US is S&P 500 is nearly half of our global portfolio, but there are reasons to be underweight. The other thing that is quite interesting, another reason why we're comfortable to forecast the depreciation in the dollar, is the freezing of Russia's FX reserves by the US. So, as I said, Russia has 1/2 of its foreign currency reserves in dollars, and the US and EU have agreed to freeze that. Russia can't access those assets. Now, if you're sitting in Russia, or if you're sitting in any country in the East, China in particular, they're probably thinking, well, we've also got a lot of FX reserves. We don't want to do something that annoys the Americans and suddenly we lose access to our foreign currency reserves. So there's a very strong possibility that this is a catalyst that leads to a lot of the world, and particularly in the East, we're looking at the Middle Eastern bloc with their petrodollars and their FX reserves, China, Japan, possibly, definitely Russia, all moving their foreign currency reserves away from the dollar. That'll lead to a will have a huge impact on the dollar. I mean, they will do it over time, but that certainly is a headwind to the dollar. And while the dollar sits at a 20%, it is 20% expensive on a purchasing power parity basis to any other currency. Well, not only is now fundamentally expensive, but there are catalysts to expect that it will depreciate over time. And that certainly is good for commodities, and that's good for South Africa, and it has all sorts of follow-on impacts. It is very good for emerging markets in particular. So moving on to emerging markets, didn't do as badly as people thought in February, partly because emerging markets have a very large exposure to oil. So while Russia had a direct negative impact, the rest of emerging markets, particularly Saudi Arabia, had a positive impact from rising oil prices. And we do think oil prices will stay elevated, unlikely to escalate further, but will stay elevated, which is good for emerging markets. And China also had a decent month. The Hang Seng Index climbed more than 3% in the best post-Lunar New Year holiday since 2009. The People's Bank of China continued to pump liquidity into the bank system. 290 billion was employed into the market. China's total new social financing from 2 trillion renminbi up to 6 trillion. That's a massive increase. All positive catalysts for growth being supported by the government in China. Inflation is also very well contained. As I said before, compared to Europe, inflation at 5% and US inflation at 7.5%, Chinese inflation is at 1.6%, giving them ample room to keep interest rates low. Yes, there are some regulatory concerns, and it did lead to some sell-off of tech stocks again this month. Ride-hailing and companies and food delivery companies that are online face some scrutiny over their fee caps, but there was no hard numbers being put into place. But it did lead to some uncertainty. And yes, there is geopolitical concerns that one of the big impacts of Russia's invasion of Ukraine is not only rising energy prices, but it certainly is China aligning itself more closely with Russia, and Russia and China forming a stronger Western bloc. So it's something that needs to be monitored. But as I said before, emerging markets benefit from a higher oil price. Emerging market currencies will certainly be beneficiaries of US freezing Russia's FX reserves. What else? What other areas if they want to avoid developed markets, then to avoid those FX reserves being frozen, they're going to look to emerging markets. So there could be some strong benefits there. And then, more importantly, looking at the chart on the right, emerging markets have already built up a sufficient barrier to the Fed raising rates. So first of all, the Fed's not going to be forced to raise rates too quickly, and it is certainly behind the curve. So the red line shows the US policy rate, still sitting close to zero, and the green line shows the US 2-year bond yields. And there's quite a close correlation over time between what the market forecasts for the 2-year bond yields and how the Fed follows that. So the US 2-year bond yield sitting at 1.5%, forecasting some quite steep increases in the US, which obviously haven't happened yet, but will happen this year. But the yellow line is most important, and that's the emerging market central bank policy rate change. That excludes Turkey, but it just shows that emerging markets as a whole are well ahead of the curve when it comes to the US raising rates. And that should lead to less volatility. Normally when the US raises rates, people will sell emerging markets to buy US because it's more favorable. Suddenly you're getting a better yield for a safer haven currency. But emerging markets are well ahead of that. South Africa in particular, we've also raised rates twice. So we've also ahead of the curve. And so that when the US does start to raise rates, there's unlikely to be as quick a switch out of emerging markets into US bonds. And that combined with the possible headwinds to the dollar and US bonds and treasuries because of the FX freezing of Russian assets means that emerging markets are probably going to do fairly well this US rate hike compared to how they have done it in the past. This all talks to us remaining avoid emerging markets. Yes, it was disappointing to see what happened in Russia, but we do think that this is a long-term positive catalyst for emerging markets. We haven't started to nibble on emerging markets yet any further. We are watching it quite closely, but we haven't started to buy yet. We have started to buy European markets. We think European markets are unlikely. It's unlikely to be a full-scale cessation of gas imports from Russia. So the medium-term impact to Russia to Europe is just rising energy prices, high inflation, and we think that is easily dealt with. And so we have started to nibble at European assets and increase our overweight there very slightly. Then over to South Africa. So we had quite a busy month in South Africa. We had the State of the Nation address. We had the budget, and those were actually relatively neutral, maybe even positive, but certainly not great. And we did have some of the credit rating agencies come out to say that it wasn't nearly enough, and that they will continue to watch South Africa's credit ratings to see if further downgrades are required. So what was the outcome? Well, there was an extension to the social relief distress grant. Cyril did announce that at SONA. That has been extended for a year at a cost of 44 billion rand. And certainly when you look at the level of unemployment that's sitting in South Africa, the poor growth that we're experiencing, the poor job growth that we're experiencing, the 75% youth unemployment, it is a necessity. How that evolves over time and whether that gets extended again for another year, or whether it becomes a more permanent living wage is busy being debated, and we'll have to see what happens. But beyond that, at least this year with high commodity prices, South Africa was easily able to afford it. There was 182 billion rand in excess revenue due to the commodity windfall and high commodity prices. Most of that was spent, partly on the extension of the social relief distress grant, partly on higher wages, but some of it was used to pay down debt, which is good. And the debt to GDP now no longer peaks at 78% in 2024, 2025, it peaks at 75%. So there's a small decrease, but still way above your emerging market average of 40%. So things certainly are not pretty. It just didn't get any worse. And I suppose that's something positive from what we've been going through for the last 3 years. So we should take that as a win, and maybe take it as a change of pace that we bottomed and things will improve. Corporate tax rate was cut from 28% to 27%, but positive. However, it was largely funded by a reduction or restrictions on the use of tax loss. Tax losses are now limited to 80% of the loss, and limited to 8 years in terms of rolling those forward. So there have been some balances to that, and generally makes it simpler, which is, to me, I always think is a good thing. Simpler tax is always better than more complex tax. And there was also an inflation adjustment to income tax thresholds, so we're all going to be getting slightly more money in our paychecks next month, which is fantastic. And a big change, which I'm going to talk to you about later, is the change in the institutional offshore caps from 30% global plus 10% Africa to 45%, flat 45%. That is quite a big impact. So the budget was generally good, but it was also, it was the same. It was the same. State of the Nation address was the same as it has been in the last 3 years. The budget was pretty much the same thing. Cyril has been promising the same things for the last 3 years. Everyone knows what needs to happen. Everyone's in agreement. The talk of the social compact is very positive, and hopefully that will come soon. Talk about fixing Eskom is positive, and hopefully that will come soon. The talk about fixing visas is positive, and again, should come soon. Talk about the spectrum is positive and has been promised the last 3 years, and hopefully will come soon. But the bottom line is we haven't seen any reforms. They just keep on being promised. And that's why the rating agencies weren't that impressed by the details. And one of the concerns is, what is next to fall? We've had some terrible outcomes at a variety of SOEs. Bankruptcies in Eskom, Denel, SABC, Land Bank, SAA, all looking quite horrible. And the concern is that municipalities might be the next block of state-owned enterprises which are impacted and possibly default. Only 1 out of 15 SOEs had a clean audit, and the Auditor General highlighted that 167 billion rand in irregular expenditure happened in the last year, again rising to a new high. And only 11% of municipalities had clean audits. If you look at the chart on the right, you can see there that all the municipalities have been downgraded, and a number of them have been downgraded to junk status. And what is concerning is that municipalities rely on largely on tariffs that they add to electricity, which they then pass on from Eskom. Now, Eskom is now turning around and trying to collect the money that they owe, that the municipalities owe to Eskom, and they haven't got the money to pay. So what happens when Eskom's pressure gets passed on the municipalities and they can't afford to pay? Similarly, there are some new regulations that are being proposed that are going to allow direct sales of independent power producers straight to end users, bypassing the municipalities. If that happens, if you cut out the municipalities, well, once again, their revenue falls by a third. But that has all sorts of knock-on impacts to consumers, onto service delivery, to social unrest. It's not pretty. So it's something we are going to be watching quite closely. So while, yes, SONA and the budget were neutral to positive, reforms are desperately needed to make sure that we don't see further social unrest and riots in South Africa. Now, as you're all well aware, we've long been long or overweight South African bonds, just because the yield is so strong, and most of the risks are priced in. And over the month of February, we saw a nice rally in South African bonds. Most of that, though, wasn't a result of South Africa-specific issues. In fact, it was despite South Africa as usual. Our budget was despite South Africa because there was a revenue windfall, and our bonds are rallied despite South Africa, because South Africa, for a change, is the cleanest of the dirty laundry. And if you look at what's happening in Russia and Brazil and Turkey, well, South Africa is at least it's a known risk. And because growth is so terribly poor in South Africa inflation has decoupled from global inflation. We've seen inflation spike in a number of other emerging markets, and the US and Europe. South Africa hasn't spiked, and that's because growth is so low that there isn't any pass-through inflation. There's no demand-driven inflation. With growth at 1%, you can't expect inflation. And so that's also given some comfort to foreign investors. And so foreign investors have been big buyers of South African bonds over the last 2 months, and that has helped support bond yields. We've been using the volatility quite nicely to take advantage of that and to make some alpha. So bonds did rally close to nicely. We reduced our bond overweight, and then post the Russian invasion and rand weakness, we have again increased the overweight. So the volatility that markets are facing is certainly something that we use in all our balance funds to add alpha, and we find it, although we find it stressful, it is certainly something that needs to be harnessed, because volatility is something that's not going to go away, and it certainly should not be ignored. So how does it all fit together in terms of our positioning? Well, no major change. We are underweight South African equities, as we have been. We are overweight South African bonds, as we have been. We are overweight global equities, and we have been using the fall, as I mentioned, to top up. So over the last 2 months, we've topped up European stocks. That was the most recent. But at the beginning of February, post the big rotation out of tech stocks, we did top up fourth industrial revolution slightly more. So we've increased our weight in fourth IR. We've also increased our weight when the announcement was made, the further increase in China tech regulations, not around ride-hailing fees and delivery fees. We increased our exposure to China slightly as well. So all small increases, but we've been nibbling at Europe. We've been nibbling at, nibbling at Europe, nibbling at fourth IR, nibbling at China. As I recommended last month, value continues to do well, but we're not taking profits there. I said that that the FTSE 100 was a great proxy for value, and that was one of the best performing markets last month, the month of February. Certainly, it is well insulated from tech, and although the gas prices have increased as a result of the invasion, it's relatively sheltered compared to the rest of Europe. So that remains to be in a good place to be. So we have direct exposure to value, but those who can't access value using the FTSE, the Sygnia FTSE 100 ETF is a nice proxy for value. So that's where we've been nibbling. We have small overweight global real estate as a proxy for global bonds, or proxy for gold, or just for our global income assets. Just because we're so underweight global income assets, we haven't got any FANG exposure. On the emerging Asia side, we're still very overweight, and I mentioned topping from China. Health innovation, we're still overweight, that continues to do nicely. Had a tough January, but that has picked up and recovered quite nicely in February, and value remains a cornerstone of our portfolios. Now, that's all funded by being underweight the US, and one of the reasons we are underweight the US is, as I mentioned, the dollar is 20% overvalued on a PPP basis and purchasing power parity basis, and we are concerned that the US is overvalued. Now, one of the big changes that happened at the budget, and is now in place, is that we can now increase offshore assets from 30% in global ex-Africa and 10% in Africa, so combined 40%, to a flat 45%. So there's no longer a distinction between Africa and the rest of offshore, and that cap's been raised to 45%. So very important question, what do we do? So we've run a number of simulations, millions of simulations, looking at historic correlations of various time periods, because as you look back at various time periods, you have different correlation outcomes and covariance matrices. And then it's forward looking, because depending on your assumptions going forward, you can have a variety of different outputs. When it comes to modeling, garbage in is garbage out, and you can't just have one input to model, because you'll get one probability distribution outcomes. You've got to have a variety of inputs and look at a variety of blah, blah, blah. Anyway, blah, 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 blah. So we have been looking at it quite aggressive. So it all depends on what your outlook is, basically. And we do have one of our biggest forward-looking scenarios. We do think the US is not going to do nearly as well as it's done in the past. We do think emerging markets are going to do better than that they have in the past, at least over the past decade. And we don't, we're obviously quite bearish on developed market bonds, because we continue to believe that has been impacted by quantitative easing. So our forward-looking assumptions haven't changed much, although we have tweaked them slightly. So we are still reviewing those simulations. We don't see a massive change. We currently, our highest risk fund has a strategic asset allocation of 28%. That will go up. It certainly is likely to go up. How much it goes up, we haven't yet confirmed, but we certainly will be talking more about it. And I think probably have a webinar discussing that in particular, to how much offshore should you have. It's always been a big question. But and this is, I want to stress this point, because it's something that I have mentioned many times, and that's why our offshore allocation is not going to go up massively. We spend, yes, and people say, oh, South Africa is less than 1% of global GDP, so you shouldn't have any money in South Africa. But you live in South Africa. Your liabilities are in South Africa. You spend in rands. Your pension fund needs to be in rands, because that's how you're going to be accessing your assets. So look at the last 18 months. if you look back over the last 18 months, the capped SWIX is up 37%. The MSCI World Index is up 12%. That's a 25% difference. So if you had all your money in global equities, you would have underperformed over the last 18 months by 25%. 25% is a massive, massive number. So it is very important to understand that it's not just about returns. It's about balancing returns and risk. And when you're looking at risk, your risk is in rounds. So it's looking at drawdowns, peak to trough, trying to make sure that your investments are as stable as possible, so that when you need the money, you aren't suddenly underperforming by 25% and you're retiring, or you've got to pay for an education policy or whatever it may be. And yes, your fund is doing fine in dollars, but it's not looking great in rands. Or you're following the world index, which is 70% US, and the dollar has weakened relative to other currencies, or the S&P has weakened, and suddenly, yes, it's not doing too badly, but again, lagging your other portfolios by 25%. So while diversification is important, and it's great to have exposure to uncorrelated assets, in particular to get growth exposure, because yes, the reason why we underweight South African equities is because growth here looks so poor compared to the rest of the world. But that must be balanced against the fact that we live in South Africa. So that's a lot of talk without an answer, because I want to highlight the risks on both sides, and I want to highlight the fact that while we will be increasing offshore, it's unlikely to go all the way to 45%. And so we will certainly talk more about this at the next webinar. Two other things I wanted to talk about is firstly foreign currency funds. So for investors who are familiar with Sygnia funds, the Fourth Industrial Revolution Fund and the Health Innovation Fund are now available through our Irish platform, the Prescient Irish platform, in dollars. So if you do have money sitting offshore in dollars and you'd like to diversify away from dollars, we'd like to put into some funds that you're looking for growth, then you can get two funds that you are very, very well acquainted with. Health Innovation is a fantastic portfolio to match your retirement assets. It has beaten all other asset classes over time, and should definitely benefit from aging populations and increasing spend on healthcare. And certainly, as a pensioner and saving for your pension, it's a great fund. It's now available in dollars, and more importantly, on our website. So you go to the Sygnia website, you can filter by foreign currency fund, and you can see the marketing sheet for those funds, and get access to the instructions on how to invest in those funds with dollars. And Fourth Industrial Revolution, as I said, we are topping up on that. That's hugely underperformed the S&P 500. All the premium related to other US assets has disappeared. Growth is definitely still looking expensive relative to value, but small cap in the US is looking very cheap compared to large cap. And the Fourth Industrial Revolution does focus on small cap holdings, and it's very diversified with 500 stocks. So that's a good place to look at. And that's now also available in dollars. And the prices of these funds are very, very competitive. So please have a look at those two funds. And then if you have dollars, but you're not quite sure what to do with those dollars, the Sygnia Global Income Fund is the third fund that is there, that invests in green bonds. So it's got an ESG theme, and very nice to diversify your dollars. It is an income fund, not a cash fund, so it's got a slightly higher yield. So instead of earning 0, you're earning about 0.5%, and that's in very short-dated income assets, green bonds, which are A-rated, so safe green bonds to look after your capital, focusing on capital preservation. So those three funds are now there, and you can go to our website and find out more about it on our website. So please do, if you've got dollars and you're looking for a home for your dollars. Then, most importantly, sure everyone is going to ask this question in the Q&A, so let me get ahead of it. What are we doing to our own funds with regards to the increase in the global limit, 45%? So our RAs have already been changed. So you can increase the offshore exposure in your retirement annuity on our platform, the Sygnia online platform, from 30/10% to 45%. So anyone who wants to increase their RA offshore, you can do that immediately. So as I said, please exercise caution. We don't think you should go to 45%. And that's we will certainly increase, but not all that way. And we also think that the timing might not be just right yet, because South African rand does benefit from higher commodity prices, and the rand is likely to as other EMs improve slightly as the risk premium about the invasion comes down, the commodity prices stay elevated, and South Africa is a beneficiary of that. Then, most importantly, for living annuities and endowments, we are raising the cap there. So any existing investor and any new investor, if you can immediately go onto Sygnia online platform, and you can increase to your offshore exposure to 35%. And we may increase that further over time, but right now we've increased to 35%. We want to make sure it's done in a responsible, stepwise measure. So that is now open, and you can increase that exposure. As I mentioned, we're still running our simulations to see what the changes are to our funds. And we do have some ideas of what to do now and what to do long term. Because again, it's all about timing. Just because South Africa changes regulations today doesn't mean that you should be buying global today. And it's very important you don't suddenly see an event, a regulatory event, as a catalyst for an investment event. All that's happened is we've got freedom, and we welcome the freedom. We're very, very, very excited about the freedom that is being provided to us by the changes in regulations. But we're going to be quite tactical in how we increase our offshore exposure. So already we've increased our offshore equity exposure by 1% over the last 2 days, just nibbling, as I said, and taking us over 30% equities. But we are going to increase that tactically going forward at the appropriate time. There's not going to be a big bang change because that doesn't mean that you should be buying more on the day. And timing in a volatile environment is very, very important. And not panicking when markets fall is very, very important. And not being greedy when regulations change is also very, very important. So that's a mouthful. And then finally, we've also launching this month the new fund in the skeleton range. So the skeleton balanced range is my favorite. Skeleton Balance 70, as I unashamedly talk about all the time, is my favorite fund, and where I have all my retirement savings. That, despite the volatility of February, had a positive return, which was fantastic. So protect capital and beat inflation for the month. But besides that, we are launching a new fund in that range. So we've got Skeleton Balance 70, 60, and 40, and then we're now launching Skeleton Balance Absolute. And that we will have a webinar on this, but it reaches the gap between a 40% equity fund and cash. So a lot of our investors are trying to find something lower risk than 40% equities, and they're just going half into cash, half into 40, and there are more efficient ways of doing it. So Skeleton Balanced Absolute, and we're launching a similar on the life license. So there's Skeleton Absolute, and there's a Signature Absolute. Those all achieve a similar return to being half in cash, half in 40 funds, but much lower risk because they take exposure to other asset classes which we don't currently have in the Skeleton Balance range. We don't need them. Asset classes that do have lower return expectations, but when you're prepared to put half your fund in cash, rather than put half your fund in cash, that you can do other things. So global properties have come into as an asset class. Inflation bonds have come in as an asset class. Even local property was considered as an asset class, and those have all improved the diversification and risk return balance of that. So please look out for that webinar. anyone who's looking for inflation +2 target, who's looking to access their money in about just on a 2-year time horizon. So you don't not quite ready for cash, but you want slightly more returns, but you are being very conservative and you are looking to spend that money or access that money in a year or two. This is the perfect fund. As I said, we are rolling out in 3 different versions: a signature version, a skeleton version, and a skeleton balanced version. And we're quite excited about that completing our range. So that was a lot. It's been a busy day, a lot to discuss. Thank you so much for listening. Let me have a look at the Q&A and see if there's any questions that I have missed and that I can still access. Good question from Justin. Why can't investors access the Sygnia Life Berkshire Hathaway Fund? That is certainly something that we will give access to soon. We are busy looking at that. It's just while we've been able to do a rapid change on our systems over the last 2 days to give you access to the higher limits, Berkshire Hathaway, because it also fits in as a single stock. So it's just more complicated from a Reg 28 perspective, and there are further limits to consider. We're obviously changing those limits, so shortly there should be access to Berkshire Hathaway as well. Apologies for that delay. Yes, and that's very exciting. I'm a big fan of Berkshire Hathaway. It is certainly a nice way to also, if you want exposure to the US, but US value, Berkshire is a great way to do that. Exposure to infrastructure, lots of cash in the balance sheet, some industrial and bank exposure, very nice. Barbara asked, which currency will take the place of the dollar if any? Okay, so that is a fantastic question. I mean, the dollar still makes up more than 2/3 of foreign currency transactions in the world. It makes up more than 80% of emerging market debt. But as I said, I think the freezing of Russian assets is a big catalyst. Suddenly, anyone who doesn't want the US to be controlling their lives, anyone who's got a slightly different outlook than the US, on whatever it may be, from obviously invasion, but it could just be ESG or other things that you have different views, different political outlooks. That's good. Those countries are going to diversify from the dollar. So where to invest? Well, what's nice about investing in equities is that you do get exposure to the underlying currency of the equities. You buy Euro stocks, you get Euro. You buy Japanese stocks, and there's this Sygnia, MSCI Japan. You buy emerging markets, you get exposure to emerging market equities, you get exposure to a basket of emerging market currencies. But so on a purchasing power parity basis, the cheapest currency right now is the yen, and the second cheapest is the euro. So if you are looking at just from a pure currency perspective, your best bet is to look at buying Japanese equities. Second best is European equities, and that's certainly why we're comfortable being overweight both Japan and Europe within our global equity portfolio. Yeah, similar question that follows on to that. So yes, other countries, other developed market countries and emerging market countries will have to deal with this with a stronger currency as the dollar weakens. But what's most important is that in the short term, a lot of countries price their debt in dollars. So a weakening of the dollar weakens the debt of other countries. So it does have quite an asymmetric impact. Yes, all the other countries now suddenly it's more expensive to export in dollars because their currency is strengthened. Imports are slightly more, commodities might get more expensive because the dollar is weaker, but at the same time, debt becomes cheaper. And that has a very big impact because debt is the highest it's ever been in its history. So the price of that debt has a massive impact. And if the US is raising rates and their debt's becoming more expensive, and the dollar is weakening and the rest of the world's debt is becoming cheaper, well, that's very positive for the rest of the world growth and the rest of the world equities. Yeah, SA's impact from Russia is, I suppose, slightly positive at the moment. So oil has gone up, and we import oil. but the PGM basket's also gone up, and we are a big exporter of PGMs. There has been also just a slight premium placed on generally on commodities, as Russia does export other commodities. So iron ore's gone up, and in general commodity price basket has gone up, and gold has gone up. We mustn't forget, although it's shrunk massively from 20 years ago, gold is one of our exports, and we do hold our foreign currency reserves in gold, which is good for the rand. So I suppose on a net basis, it's neutral to slightly positive, but certainly wouldn't be that excited about it. Certainly, it's helped South African equities, but I think a lot of that is in the price, and I think a lot of that will mean revert. I think a lot of the gold prices will mean revert, but as you know, I'm not a long-term gold bull. So if you are a gold bull, well done again. Duncan asks about our core satellite views. He says yes. So we've got a core of MSCI World, which is quite heavily dominated in US, and then you can buy out on a global basis, and you can buy your global thematic satellites. Fourth Industrial Revolution, as I mentioned, health innovation, emerging markets. He wants to know, how do you change this to reduce your US exposure? So the best way to do it is to, as I've said, we don't have any direct FANG exposure. We've got a small exposure to fourth R, which we are increasing. But I think that the best thing to do is to decrease your core slightly, so reduce your MSCI World slightly, and then increase that to other asset classes. So our property ETFs got a small allocation to US, still got some US small allocation. Healthcare's got some US exposure, but again, smaller. Emerging markets obviously don't have any US exposure. So by increasing your exposure to the non-FANG thematic satellites, you can, and decreasing your core, you can diversify away from dollars. But again, this view is a 10-year view that I'm talking about. The dollar is not going to depreciate overnight. It's not something that you need to rush and do, but it's something you can piecemeal do bit by bit, smaller nibbles over time, tranches to reduce your risk. No overnight big changes. As I said, it's going to take a long time it's going to take 10 years for the dollar to depreciate. And US tech companies are fantastic companies right now with massive moats. Yes, they're expensive, but unless there's a catalyst that impacts tax or antitrust or regulatory sides, it's also going to take time for those to derate. So no need to do any major moves, but certainly at the margin over time, decrease your core, increase non-US satellites. Hilgard asked why we were exposed to the EU over the last 2 months. So we had a very small overweight to Europe to balance our US underweight. So we weren't expecting Russia to have a full-scale invasion. So we certainly got that wrong. But it was a very small overweight. And as you saw, the US did as badly as Europe. In fact, the US has done worse over the last 2 months than Europe because of what's happened to big tech. But it was only this month that we've actually gone a net overweight in developed markets and made it a large exposure to Europe. So again, we take very small bites. We're very worried about risk, and we don't do anything in large sizes. Errol asks about crypto and whether it's time to get in because of crypto regulations. I remain a crypto bear primarily because it has infinite supply, because there are infinite number of cryptocurrencies. While I do like blockchain, there's no one particular cryptocurrency that I think is the best. Yes, commodities have done very nicely, and particularly gold, out of Russian-Ukrainian conflict. But what was interesting is that in the beginning, when Russia first invaded Ukraine, one of the worst performers was Bitcoin. It subsequently rallied, but when gold was doing well, as I said, having Bitcoin wasn't, which again, is Bitcoin a protection against inflation? No. Is it a protection against geopolitics? No. What is it? Well, it's a play on blockchain, and a lot of people believe it has value from that perspective. I'm just not one of them. So I'm the wrong person to ask about Bitcoin. I still don't have any. Yes, skeleton balance 70, we will be increasing the global allocation to that. As I said, we've already increased the global allocation. It's currently sitting at about 32%. So we have increased that beyond the 30. It was already slightly over 30 with some Africa exposure, and we've increased. So that's we are sitting already at 32% global, and we'll probably increase that further tactically when the right time arises. How far we'll take it, we're still running simulations to see what the perfect new level is. John asks what actions we've taken to address the performance of Fourth Industrial Revolution and FANG funds. Unfortunately, that is just an impact of volatility. There's nothing we can do. Our philosophy is the same. Our investment process is the same. We're buying the same stocks that we used to buy. We're not making any changes to Fourth Industrial Revolution or FANG. We think they're fantastic portfolios as they are. We do believe that they will do well over the long term. But as we've highlighted, rising interest rates are a headwind, and that certainly has been what's hit Fourth Industrial Revolution. It's derated considerably on the back of rising interest rates. So we now think a lot of that is priced in. FANG still hasn't priced in a lot of the increase in interest rates. So we think there could be a bit more headwinds there. But again, we're not changing our philosophy, we're not changing our process. We think those are fantastic funds. They currently have macro headwinds, and there's nothing that we are doing within those portfolios. Yes, at the margins, we have rotated some exposure into China tech and to European tech, and that has protected the fund somewhat, but that's again at the margins to reduce risk. We're not fundamentally changing what those portfolios are. We certainly think over the medium term that Fourth Industrial Revolution will do very nicely, and FANG, maybe over a slightly longer term, will do nicely. So Desiree asked me to confirm my dollar. The US dollar is 20% overvalued on a purchasing power parity to other developed market currencies. It's probably further overvalued relative to emerging markets, but emerging markets tend to always trade at a discount. So it's much more difficult to use PPP to value emerging market currencies. So I don't. And so my 20% was to a basket of other developed market currencies like Euro, Swiss franc, and Japanese yen. Claire, I'm not sure about your question regarding tax, so please email Sher and she'll pass it on to the relevant person. Francois asked about China risks with Taiwan. Yes, certainly there are risks, but that China and Taiwan's state has been relatively stable for a couple of decades. And yes, there has been a lot of concern that China might use this as Russia's invasion of Ukraine to do similar to take over Taiwan. It is a risk. It's not a risk that we think is likely to happen, and so we aren't pricing for that to happen. That's why we are overweight China. We think that everyone's happy with the status quo. The US has not claimed that Taiwan is independent. The US backs China's view that Taiwan is just another province of China. And so there's no need for China to do anything drastic right now. And so unless the US starts to get antagonistic, the status quo will stay, which is that Taiwan is just part of China with a different currency. That's how everyone looks on it. That's how everyone agrees it is. Yes, it's embarrassing. Yes, it's a bit complicated. Yes, it's what's happening. But I don't think, in fact, I think possibly, particularly now, when everyone's seen the bloodshed and horror that's happening in Ukraine, that China's unlikely to escalate to military action. It doesn't need to. It's getting what it wants out of Taiwan, but it is a risk, and it's not a risk that we discount, but it's a risk that we think has because it does have a large impact. It happens, but we think it's got low probability event. Miles asked a very question: which Sygnia fund rules them all? See, we've got a Lord of the Rings fan. And unfortunately, I'd have to go with 9 rings rule them all. MSCI ESG, which at least has got 6%, which is the Sygnia S&P 1200 Global ESG ITRIX fund that has about 60% US and 6% to emerging markets, and it's got an ESG overlay, so that's great. But I would say that is your core, and then you're going to have to do a couple of rings, other of the 9 rings surrounding that, just to get some other exposure if you want to top up fourth industrial revolution or healthcare or emerging markets, whatever it may be. But certainly the core is, I think the best core is what's the listed JSE code is SIG ESG, but it's a Sygnia S&P Sygnia Standard & Poor 1200 Global ESG ETF. Great price, super cheap, and the most broadly diversified of all our global funds. But I still do think you need a bit more exposure to non-US assets. So no one ring to rule them all. So our good question on our Irish-based funds, they are priced in dollars, but that doesn't mean that your exposure is in dollars. On the income fund it is, but and it doesn't mean we only have dollar assets. Income fund, we do have some European assets and some pound assets to diversify our currency. And obviously the other 2 funds are more broadly diversified, but although they are priced in dollars, because that's 70% of global assets are priced in dollars, but your exposure within those funds is not solely to dollars. So it is a nice way to diversify away from dollars as well as rands. Victor asks, should I buy everything now? Victor, I'm never brave enough to say that. It's impossible to time the bottom. As I said, we've been nibbling, we've been buying tranches, because I think now is a good time to start buying, but I don't know if it's the best time to buy. We might miss out, we might not have bought enough, but we also might be able to buy cheaper going forward. So I'm never brave enough to say that, and that's why I always like to nibble and do things in tranches and diversify over time. Johan says it's time to reinvest in big tech. Yes, the FANG funds have had a massive fall, and I think there could be a tactical bounce. I think Valley has done so well over the last 2 months. We could see growth bounce back over the next month or 2. So tactically, people are buying growth for a small bounce, and people are buying FANG. Could buy FANG for a small bounce, but it is small. It's very short term, and I think it's the same as buying any assets that are benefiting from Russia's invasion of the Ukraine. It's a short-term tactical investment. I'm sorry, not investment. So short-term tactical gamble, and you can get it right. You can buy now, hold on for 10% and sell in 2 months, but you can also get it wrong. So I always like buying stuff that if it does get cheaper, I still want to hold it, not buying expensive stuff, hoping it goes up. And if it doesn't, I have to sell, because then you've got to start cutting losses and incurring losses. And it's not nice. Yeah, and one last question on Nigeria. Yeah, Nigeria certainly will benefit from rising oil prices. It's its major export, and Africa in general actually will benefit from rising oil prices, which will be good for some of our companies which still have exposure. SA-listed companies still have exposure to Africa, like MTN. MTN has really run pretty hard, but certainly, as oil prices rise, means more supply comes online, and Nigeria will similarly bring on further supply, which is good for them, but will overall cap oil prices. And that's it for all the questions and answers. Thank you very much, everybody, for dialing in during these turbulent and volatile times. I wish you the best of luck in the markets over the next month, and I really do hope that we have a diplomatic solution soon, so the atrocities and tragedies in Ukraine come to an end. It is certainly a terrible event. Yeah, thank you very much for joining. All the best.